Well, folks, thank you for coming. Welcome. Want to thank Goosefoot for sponsoring us and opening up their space to us. And hopefully you folks can learn something today. I'm with Internal Revenue Service, and my job is outreach and education. And that's what we're here for today, focusing on it. Probably maybe you've already claimed something like this previously, but it can be a fairly significant deduction. And the goal really is don't pay the IRS more than you should. So that's what we're going to look at today. And the timing seems to be right. You got one of the family circus here, 4 seasons, spring, summer, fall, winter, and one more, tax season. So it's that time of year. And if you're getting your tax return prepared for April, or if you're one of those folks who has an extension till October, it's still worth thinking about no matter where you are in the planning, able to show what kind of deductions you need. And so we're going to go over a specific type of deduction. We have a lot of other deductions. Income deduction. It sounds like a big, what it really means is that there is something built into the tax code that's just been approved again for 20% of any business person's gross income is deducted from what you need to report right off the bat. That's just one of the deductions. One of the other big ones today is business use of your home. And so let's get right into it. So a couple things to be aware of. Business use of the home and tax law in general changes all the time. So whenever you do get down to business and decide it's time to start putting these things together, be aware there are some changes. And if you have done things in the past, just know that these are a couple of the changes in the last 5 years. And even though it's been more than 5 years here, I guess it's now 6 or 7, some of these are things that people still carry forward from having done it previously. So first, right off the bat, if you're an employee of someone else, if you are an employee of someone else and they ask you to do work from home, that used to be deductible, your office space, that kind of thing, not any longer. So this is for business owners. An employee can't deduct. The other thing is there's a limitation on the real estate taxes that you can deduct. It's limited to $10,000 if you, or $5,000 if you're married filing separately. So be aware, real estate taxes is one of those things they cap. But that's one of the things that you will be able to deduct, and we'll go over those. So here's what we're going to get into today. How to calculate what you're going to deduct, how to figure out what's the dollar amount that you get to take as an expense of your business. What does it mean to qualify as business use? What are those requirements? What check boxes do you have to check in order to meet these? Then talk about things like what they call business percentage. And that's going to get into how much you use something for business versus personal, the different kinds of expenses you can deduct, and the limits. We saw a couple of limits on the last screen. And then the best part, where to deduct these expenses on your tax return. A couple of the terms that the IRS has, and you're going to find this across the board with my agency, half of it is learning how the IRS uses English. And what is a home? Well, the good news is it's broad enough that you can bring in anything that you are currently paying a mortgage or rent or you have access to. So it's your home. It could be a room in your apartment or condo. It could even be a mobile home. Don't feel like just because you live in a mobile home, you can't deduct expenses. Similarly, don't feel like you can't deduct the expenses for your detached garage, or maybe you have a shed out in the back or your studio. These are all potentially deductible for your business. So just because it may not be part of the home, doesn't mean this term doesn't apply. So there's, broadly speaking, going to be two main methods to deducting your home expenses. The first one is the simplified home deduction. This one is going to be easy to keep the records for, because really the IRS has no records burden on you. We're not asking you to keep a lot of records for this style. But this is only going to be applicable to small businesses. Part of the reason why I say that is it's capped at $1,500 per year. That may be enough for you. If you have a small business and you're just getting started, that may be plenty to cover all the expenses for the types of things we're going to talk about. Home internet, that space that you have that you only do your business work in. But it's, roughly speaking, $5 per square foot. So if you only have 200 square feet that you're dedicating to business, well, then you're going to be capped at 5 times 200 and $1,000 a year. So keep in mind, this one is for small business, but the good news is you don't have to keep a lot of records. You don't have to prove anything to the IRS. Any business person can just simply calculate how much space they are using. They get $5 a square foot for it, and then they can deduct it. Now, they say standard method can be complex and burdensome. Well, so I guess is running a business, right? If you're already in business, you know there are things that are easier than others, but record keeping, I don't think, is everybody's favorite. But that's really what the standard method is going to involve more of. But you might already be doing this record keeping and just not know how to take advantage of it. But still, I want you to know that this is available. So if your business is small enough, this might work for you for many years. You get to decide in any particular year whether you want to use the simplified method or what we call just the standard method. And what that means is during the year, you can't switch from one to the other. So let's say your business grows dramatically, you get a big project, and you decide, I'm going to need a lot more space. So you build a small shed, and that's just for business, and you start doing business out there. But prior to that, you didn't keep all the records for the year. Well, you can't switch during the middle of the year. It's one or the other. IRS wants you to use one or the other. Simplified method just means you're not really paying much attention to the actual expenses. You're just paying attention to the amount of space that you're dedicating. But the standard method, which we're going to see in a little bit, although they might say, oh, it's a little bit more burden, it may be totally worth it dollar-wise to have this deduction available. And that's one of the reasons we're going to spend a lot of time on that. So you get to deduct actual expense under the standard method. Simplified method, you're just reporting the space. So we've got a room, let's say a room 300 square feet. That room you could dedicate totally to business. And then how do you report that? That's $1,500 that you deduct on the Schedule C. The Schedule C is another class that I've done with this program. We will do it again later this summer. The Schedule C is basically where a sole proprietor or even a S corporation sometimes can use a Schedule C, or sorry, not an S corporation, an LLC. You could report your income this way. Schedule C, I like to think of as your costs. That's not officially what the IRS calls it, but I like to think of it because that Schedule C is really, what are my costs of doing business? And you already earned money. You're paying your expenses with money you've already earned and paid taxes on. So in your business, Schedule C is designed to show that money is not taxable in this current year. You have it from your investments. You have it from last year's profit, right? So there is a simplified method worksheet in the instructions for Schedule C. But again, it's a real simple calculation. Square footage times $5 a square foot equals your deduction you put on the Schedule C. Before I get into the standard method, I'm also going to just talk about what are the requirements? What does the IRS need from you in order to show that this is use of the business? First of all, be aware the deduction may be limited. So it's going to be limited by the amount of income you have, the amount of space you're dedicating, by the use of it. How much are you using it? And I'll get into specifics and look at some examples as well. But the big word that the IRS is looking at is exclusive. So what does that mean? Well, you're using a part of your home or your shed or wherever only for business. That can be complicated sometimes, right? Maybe you work in an apartment that's wide open. So how do you do that? I'll talk about that. Then it must be regular. In other words, once a year might not count, or at random intervals. But if you're regularly doing the books there, if you're regularly balancing the checkbook, if you're regularly invoicing your clients from one desk at one computer, that's regular. Doesn't have to be a specific number of hours, and it must just be for your business, right? So you can't have a shared space and get credit for all of it. So let's get into some of the details. It's either going to be your principal place of business. So some people imagine, let's say you make art and you have what used to be a garage, but now is a space where you can welcome people in. That's all it's used for. There's no cars being parked there anymore. There's no lawn equipment. It's just the business space. Maybe that would be your principal place of business. Not every business works that way. And so it could be, though, the place that you meet with clients or customers. So you invite somebody in, you have a room that's off the house. Maybe it's part of it doesn't matter where it is, really. But if you meet with people regularly in this space dedicated for you to meet with your clients or to show them your products, however it works, if it's a regular part of your business, then it's clear you're going to use it for that. And real easy to prove, so to speak, if the IRS ever asks you, hey, can you prove it to me that you can have the right to deduct that? Well, yeah, I can prove it to you. A separate structure. It's completely, that's all for business. There's a sign right on the wall. So that's going to be a little easier to prove, but I'm going to talk a little bit about how your principal place of business, even if it's in your apartment, how you could make that work for you. So I think it's very helpful in this one. I like that we have some examples because you wonder, what do you mean exclusive? What is this? Well, here's an example. Ruth, a graphic designer. She's got her computer in the family room so she can watch the kids while they're watching TV across the room. She's doing design. The family uses the room for recreation. Can she claim this as a business deduction? If the answer is no. And the reason is exclusive, right? It's exclusive. So she can't claim a business deduction for its use. Okay? But let's look at another one. Greg brews natural sodas in his garage. The garage is not attached. That's the only use of the garage, brewing and selling. He uses one part of the garage for brewing. He uses another part of the garage for tastings and selling. Does this meet the exclusive use? In this case, it seems like it does. Absent any other info, yes, because it's exclusive, it's regular, it's a part of his business. This is very natural. So part of exclusive use, though, note that there are some exceptions because some of the simplest things, just storing products. If you have inventory or product samples, then there are going to be specific rules for that. So all you need to do is just look in the instructions for this. irs.gov is the resource that we would use and publish everything. And then in addition, you could even go to irs.gov and put in the specific keywords. But if you have inventory, they understand some businesses are inventory heavy. My mom used to do Avon when she was younger. And there was Inventory everywhere. Well, she gets to be able to claim part of it, even though in the same closet, there might be pantry. Okay. So inventory is a little different. It's got its own rules. Similarly, if you have a daycare facility, daycare, the measure is how many hours and how many days a year did you use your home for a daycare facility? Think about those types of industries. Every industry is a little different, and daycare specifically, you can imagine the whole house when the kids are there, or at least the house, the areas that they allow the kids, right? Those are all being used for business. But then when it closes, you can imagine it's living space for the family. So this is an exclusion. This is an exemption to the exclusive use test, because a daycare facility, you could easily imagine the kids might be in the kitchen if they're, depending on their daycare. Well, in this case, if they use that same dining room for their family, it's not going to disqualify a daycare facility. Okay. Ma'am. No, please. When you think of it, don't let it go. And in fact, even if it's not quite on topic, I don't mind. You're here, I'm here. That's talk. Yes, yes, you can. And that's going to be common, right? Imagine if you have a production facility in the garage and a place to meet clients in the house. Perfectly makes sense. Yeah, you can, or more. Mhm. Welcome. I've got some handouts right up front too, if you'd like. Mhm. Mhm. Yes, yes, absolutely. And sure. Yeah, I mean, and this is the most common question. People are like, well, I use this, I use that. How do I figure it out? Imagine if this was your apartment. I've lived in apartments that are no bigger than this, and you've got the kitchen there and the bathroom's over there. How could you deduct in your apartment like this? It's all wide open, there's no doors. There's ways you can do it. You could put up just simple dividers. Somebody asked me, well, what about my garage? I do park my cars in there, but over half the garage is used for business. Put down tape. And that line that right there says that's the space for business. Yeah, the cars are parked here and it is in a garage. And in theory, this is kind of shared. But what's exclusive to the business? I thought about it. I planned it out. I laid out tape. That's the space for business. And I'm going to be able to deduct all the square footage of that space. Okay. In other words, think it through, have yourself a plan, but don't feel like if your business looks different from somebody else's business that you shouldn't claim it. More than anything, I want you to feel comfortable with claiming a deduction that you qualify for and not be so afraid of the IRS's rules. The rules are nitpicky at times, but if you have a rational reason, you've thought it through, and you're prepared for exclusive use, you could say, well, yeah, that's exclusive, even though it's in a walk-in. That is the studio. It's the only appropriate space. Some of the terms in the law basically call reasonable. And you wonder, well, what does reasonable mean? Well, any reasonable person that has thought it through and has a rationale, an explanation, that's generally going to be enough. And we'll have more examples to kind of flesh that out as well. So the first word we used was exclusive. So exclusive use of the space. Now we're going to talk about what does it mean to be regular? Because maybe you only operate seasonally. Maybe you are a landscaper and you don't do as much in the winter. So what it means is just on a continuous basis, use that specific area for business. However, it doesn't mean that if it's occasional or incidental. So we had a snowstorm a couple weeks ago. Maybe you couldn't get out. Maybe you couldn't meet people at the business, but you said, hey, why don't you come over? You will meet in my dining room. If that was once a year because of an incidental occasion where you couldn't get out, that's not going to be regular. What the IRS wants to allow for is regular use. And the other part of it is even if you don't use that area for any other purpose, if it's only once a year, if it's only a couple times a season, that's not going to quite be enough. And part of the reason is you actually get to deduct a lot. It needs to be regular as well as exclusive. So even if you don't use that any other purpose, that's the exclusive test, might meet that, but not be regular enough. So here's another example that hopefully fleshes out some of the regular, how do we use that term as the IRS? Tom's a painter. He has a separate studio in his home, and sometimes he paints there, but most of the time he's doing landscape and he does them outdoors. Is this going to qualify for regular use? It's actually not. And part of the reason really comes down to Tom. Maybe Tom needs to spend more time in the studio, but he is stating that most of the time, if he was asked, do you regularly paint there? And he says, well, most of the time I'm outdoors. That's the difference. It's the most of the time. It's most of the time, how do you run your business? And if, for example, he paints outdoors until he's got the scene right, he goes and finishes them regularly in the studio, that would be different. That would qualify. So in this case, he can't claim this just for the deduction of the studio because it's not on a continuous basis. But we talked about a reason where he might say, I finish all the paintings in the studio. That's regular. Okay. So do yourself a favor and learn how the rules apply and make it work for you. If you occasionally use something, well, rethink maybe how your workflow works and maybe you could regularly use it. I always use that to dry the product. I always use that to finish the work or whatever. So regular really comes down to any other type of regularity, right? Is it once a week? Yes. If you can answer yes, it's once a week, then there's going to be a portion of that that is. Principal place of business is the other term we use. So we talked about exclusive, regular, and principal. Principal means it is the principal location where you're doing some sort of business activity. You can have a lot of locations and still claim a business use of the home. A lot of times people, especially when they level up and they start renting a location outside the home, they transition over to knowing that, oh, I can definitely deduct all the costs for my rental studio, my business, my storefront. It seems logical and you would be comfortable deducting all of the electric, all of the rent, all of the other costs associated with your storefront, but still you have a home office. And so don't cut yourself short if you are renting a space and you have a space that's outside the home and you already can deduct that cost. All of those costs are deducted on the Schedule C already. But what we're talking about, business use of the home, specialty deduction. So you can, though, have more than one location. You can have the building that you rent. You can also have a part of your home. You qualify for business use if it's the principal place of business. So what that might mean is you have a production facility and you're deducting that, but the principal place of business, you meet people or you bill people. If it's exclusively and regularly for administrative or management activities, that's one of the most common categories. You've got a business, but you don't want to spend all your time there. So you go home and you go to the home office to bill people, to answer emails, to work with the bank account, to file your taxes. So if you exclusively and regularly do management, it's really easy if you have no fixed location where you conduct substantial activities of your trade. Imagine if you're a service provider, right? So electrician, plumber, construction, etc. What's the principal place of their business? Well, most of the time they're on a job site. That doesn't mean we're going to exclude them from the home office deduction because just because they're at the job site more often than they're anywhere. What they will do though is if you have an exclusive and regular spot in your house right here with that desk, that computer, maybe a table to meet with people, as long as those are exclusively and regularly used for your admin of the business, you qualify. That's where I don't want you to get confused on principal place of business, because if you have a principal place of business, like a storefront, you're going to feel like that's yours, but it doesn't disqualify you from having home use of your office, because you may not want to do a lot of your admin in the office every day. So these are some of the things that we could easily imagine you do from home. And especially if you're starting up a new business, you're not just going to rent a facility so that you can try to do business. You're going to rent a facility when you know you need it. So similarly, all of these activities that you do regularly to take care of your business, these are going to be the things that naturally you might expect somebody sets up a small home office. Again, also don't, again, I come back to don't disqualify yourself before the IRS does. I find a lot of people, I've heard this in business classes before, it might not be you, but people say, well, I don't want to get audited. That may be only a few $1,000s. I don't think I want to take that. Well, if it's a few $1,000s, take it, right? This is real savings on your taxes, and nobody saves their way. You sell your way $1 million, but don't pay the IRS more than you should. And some of the things that get in people's way is they go, well, I have a CPA. I've got an accountant, or I have a payroll company who's doing my admin and management activities. That's fine. That alone doesn't disqualify you. If you at home are still doing work exclusively and regularly in a section that is just for business, how do you take stuff to your CPA if you don't have the records ready? So just because you hire somebody to do some of these administrative work for your business doesn't mean that you're not still managing the business from home. Also, conducting activities that aren't fixed locations is whatever rental for the space, but then how do you deduct home? Again, same tests, exclusive, regular, and then principal place of business. We talk about that for a craft fair person, just like some of the other types of professions. Well, their principal place can still be at home if they're doing the management of the business there. If they're going to the craft fair just to sell the product, that doesn't mean the principal place of business is the craft fair. Okay. So we're going to talk a little bit about principal place of business. Jim, a self-employed plumber. Most of his work is done and he has an office exclusive and regular tests for his small office at home. His own billing, though, he outsources everything to a bookkeeper. Does his home office get to be deducted?
Yes. Please collect data, please.
Sure. Basically, to reassure people, because I've had people say, well, I don't do my billing anymore, so am I really using it? Well, what do you use your small office for? Well, I plan, I make my designs, I research other competitors, I manage my advertising. There's a lot of things you could do for a business use of a home that if you're just regularly doing that, it counts. He's using it regularly for admin and management. And his choice to have billing done by somebody else, or having his payroll done, or all these other things, they're not going to disqualify you. Meeting place for customers. This one is going to be another clue as to whether or not you get to deduct part of your home. If you're meeting with customers in your home as a regular part of your business, then you can deduct the expenses for that part of the home. You do need to physically meet with them. If you are going to say, well, I meet with people in my home, then you need to physically meet with them, and you need to show that this is part of or required for your business. And there are some easy examples of why this would be the case. An interior decorator, for example. You know, just like the plumber, just like some of these others, they're primarily doing the work in their client's home. But rather than bring all their samples and patterns and paint chips and all these things to their client's home, they might have a space in their home dedicated for that. They bring people in and they discuss. And so meeting place for customers, this is enough. So they look at samples, they designate exclusively this office, and after they decide what they want, they spend the rest of the time in the client's home. Yes.
The majority.
Sure. That seems pretty clear to me that wherever you're at, if there's an office in your home that's just used for business, just because you're doing it on the internet, in a sense, yes, you're doing it from right there in your room. The world's way different from when this tax code was written, sure. I mean, I can remember, I just saw a movie about 1986 last night. And in 1986, nobody had a cell phone that they could look up all the information in the world. Everything was on paper. The phone was attached to the wall, or if you're lucky enough, you had one with an antenna and you could walk around with it, but you couldn't get more than 20 feet. In other words, this is one of the reasons why it's important to dig deep and go, hey, I'm online. What do I deduct? I know it seems logical that I could deduct all the internet, but is this room that I'm sitting in required? Well, you got to be somewhere. I think the big difference would be is if you did it always at the library. Well, there's nothing to deduct there, right? But does it qualify in this case? It does. And when we say principal place of business, like you said, the internet, where is it? Well, what are you doing? What do you require to run your business? And so if you're required to heat that space, pay electricity and lighting and internet for that space, that's going to count. And she meets with clients in her home on the regular course of business. Well, in your case, you're saying, hey, I meet online. Well, you're in the home, you're meeting with them. That does count. That actually does. As long as it's exclusive, in other words, you don't have, guests staying in the guest room, which is also your business. Sometimes guests stay in my office. Well, that's not going to quite work. Make sure the space is dedicated. And like I said, even in an apartment, you can, nope, that box is just the business.
Just looking at all the things. Websites, things like that. You're looking at your desk, you know the content, you're working with your clients on the internet, you don't have to see them physically.
Right. No, yeah. And when they say physical use, who's physically there? The business owner. What are you doing? I'm meeting with clients. Bam.
So you have some kind of record of what these meetings took place, and that sort of thing.
Yeah, that would be enough. It is rare, I will tell you, that a revenue agent, that's the name of the person who would be doing an audit. That's what we call auditors. It is rare that a revenue agent will go visit. But I'll tell you, there was one situation a buddy of mine I work with, who's a revenue agent, said, I had a pretty glaring example where the guy was claiming 80% of his home as deductible. And he had a 3,000 square foot home and he's claiming 80% of it. And he said, I had to arrange an in-person visit because it just didn't make sense. And so the point I'm getting at is as long as you're being fair to the government and fair to yourself, don't be afraid of being disqualified because of some nitpicky thing. In your situation, you're saying, I'm physically present and I only use this space, and maybe you only use that computer for business, right? There's a lot of things that can show that it's exclusive, regular, and you're physically present. You know, especially if you also have employees, right? Imagine if you ran a telephone marketing system and the employees are all there on the phone. Well, they're not physically meeting in person with someone, but they are physically in that space meeting with clients. Oh, sorry, I didn't even. An easier proof is a freestanding structure, a barn, a shed, a garage. And it doesn't even have to be the principal place of business or place where you meet people. It can just be the production facility used completely for that. Again, let's go back to the overarching. What are we trying to do with the deduction? We're basically trying to say this is a cost of doing business, but it's not an obvious cost of doing business like I pay rent on a storefront. What are you paying for the shed or whatever? You're paying for electric. Now, it isn't all of the electric for the home. You're paying for homeowners insurance or renters insurance. You're paying for the mortgage, the rent already on the place of residence. So what we're talking about is a specialized deduction that you just have a couple extra tests for. You're thinking exactly where we're headed. So for the first method, which was the simplified method, if it's 300 square feet or less, you get to deduct up to $1,500. If you think that's enough and covers your costs, you're good. Otherwise, we're going to talk about exactly what you're saying. You calculate what's the square footage of the garage or shed and compare that to the square footage of the house. Consider them all as like one giant square footage. And then if it's 25%, great. That means 25% of the costs of the home. So thinking ahead, that's exactly what we're headed into. Here's a separate structure question. Joanne builds custom designed furniture in her detached garage. But when they're talking about plans, they discuss it in her dining room. Now, does the garage qualify as a separate structure? Sure. That seems pretty straightforward. And it's exclusively and regularly used for her business. But she's not required to physically meet with her clients there to be able to use that. It's one of the reasons a separate structure sometimes, when you graduate from the simplified use, sometimes a separate structure is just more logical. Might as well, at a certain point, if you're using a part of your home, maybe build that garage, that shed, that barn.
It's a little extent scope of this workshop, but if you are using your home for business, make sure your insurance knows. Because if something happens, they could deny the claim because they weren't covering business use. So make sure your insurance knows that you are doing business in your home.
Part of that too is same thing with vehicles, right? Your vehicles, you want to tell your insurance company, I do incidentally use my vehicle for deliveries or meeting with clients. If you're using your vehicles for business, your insurance company is going to want to know that too. So what are your limits? Most of the expenses are limited by the percentage of space. Okay, if we're going to use the standard method, They're limited by the percentage of your home used for business. If it's 25%, you're limited to 25% of the expenses. That's the rough and ready rule. So like we were talking about, you compare the size of your home with the size of the business. If this was your apartment and you use 10% of it, this corner, then 10% of all the costs. Sammy mentioned insurance. There's renters, mortgage insurance, your mortgage itself, your electric, your internet, water, sewer, gas, etc. Once again, there are two methods here. You've got the area method, which is the one we just talked about, or you've got the number of rooms method. I find the number of rooms methods not always in the best interest of taxpayers, but again, sometimes it's just easier. So to use the area method, divide the area used by the business by the total square footage of your home. And also be fair to yourself on this as well. The total square footage of my home is listed at 1,500 square feet on MLS, right? Whatever the listing service. But what's that limited by? Well, they have different rules. Some of the unfinished rooms don't count as square footage, and neither does my detached garage. So if the garage is 500 square feet and the house is 1,500 square feet, that's 2,000 square feet total. In other words, just because you were told previously your house has a certain square footage based on when you bought it or sold it, that doesn't mean that that's the square footage we're using here. Use the actual square footage, because that garage or shed most likely is not considered as part of it under the real estate, because they have requirements on what's really part of the square footage. Garages are part of that. So here they give us some a little bit of math. If your office is 240 square feet, home is 1,200 square feet, divide it, that's 20%. 20% of your costs are for business. Other people use the rooms method. Let's say your house has 10 rooms total and you use one room. So if you have 10 rooms total, one room, it's 10%. I find that this is not always in your best interest. Sometimes it is, sometimes it isn't. But if it's easier just for you to think this way, fine. It means less deciding what the square footage actually is. The form 8829 is the form you're going to use. So we talked about Schedule C earlier. If you are a sole proprietor or you're an LLC that's taxed as a sole proprietor, you're going to be using the Schedule C. If you're an S corporation, that's the next most common one. You have a different schedule that you're deducting it on. It's on the 1120S, but it looks almost the same. It's got categories for each type of business percentage, or is each type of business expense. And then you have a separate area of business use of the home. 8829 is the expenses for your business use of the home. So you're going to use that form to show what you're deducting.
The 8829, does that hold true for both the 1120S and the 1040C? Like if we have.
It's for the 1040 Schedule C. If you're an S corporation, you're just going to want to dig in a little bit deeper. Part of it comes down to S corporations that have a single member are going to have different rules from when you have multiple members. And so whose home, what home. In cases like that, it's better to spell out an agreement with the business that the business is paying rent. That's a better way to do it. It's more explicit. So what she's talking about is as a corporation grows, sometimes you might find it's better to have a lot of tax savings as an S corporation rather than being a sole proprietor. In those cases, though, it may be better to just spell out an agreement where I'm using part of my home, but we're not calling it business use of the home. We're calling it a cost of doing business. The business itself pays you as one of the partners to use the home. Okay.
Then how do you, like, how does that
play into exclusivity in terms
If-
of like, if we've got 4 businesses,
Yep,
I'm managing all of them from the same computer and I'm switching my QuickBooks files back and forth and back and forth.
That's
between
right.
different companies. One's gonna be an S corp. And we got 3 others that are LLC, or 2 LLCs and then 1 sole proprietor.
yeah.
Is that still considered exclusive? Because it is literally all business related.
That's going to be easier on the exclusive question and on the regular question. But on whether or not it's called business use of the home, or what this is talking about is standard expenses of the business. Okay. The business, what you're trying to do is give yourself credit for what you're providing to the business. You're providing a space and a computer and all these things for the business. So even if it is, let's imagine it's a C corporation, which all the taxes are paid by the business. You still then just write it out in an agreement. Business regularly gives me $300 a month to cover costs of doing business.
And I could do that with just the LLCs, not, because I know I can do it with the S corp, which we've started to do.
Yep.
But then like literally the desks for our construction lead is right next to the boss's desk. Like
Yeah.
they share the same room.
It's just really what you call the expense. And so I think this slide is what I'm talking about here. So think about it this way. What I mean by give yourself credit is allow yourself to deduct costs. But when we talk about business use of the home, that's going to apply to a sole proprietor. That makes sense for a sole proprietor or a single member S corporation. A single member S corporation, it's their home. Even if it's husband, wife, that's still considered single member. But for an S corporation that taxes itself with multiple partners, there's no single home for the corporation. So instead, consider that they're renting the space from you. And a way to get a good fair market value of that rent is compare what you're deducting as business use of the home for the business. All you really want to be careful about is not to take that same deduction twice.
I think like, do I just have the S corp pay rent and the other businesses just get to ride for free?
That's one way to do it. Or you could decide I'm doing 30% of my business there, so I'm going to deduct this amount. In other words, for an S corporation with multiple members, you want to spell it out more clearly that it's a rental situation. Because think about their expenses that are related to your business that you're already deducting, right? Real simple. I bought a product for resale. You get to deduct that from the income you make. But similarly, there are going to be types of expenses that are going to apply in different ways. And so hopefully this fleshes out how some of these might work out. But I think in your case, just write out an agreement and give yourself credit from the business that the business claims an expense and basically they're paying you. If you're one of the only owners, well, it's roughly income. But so think about the types of expenses you have for your home. Some of them are going to apply directly to the business, and some of them are going to be split between the business and personal use. We call these our words, if you see them in the instructions, direct, indirect, and unrelated. So let me show you some examples and what does this mean? Some of your ordinary expenses, these are already deductible. All of these are not business use of the home. So if you haven't already had some kind of understanding of the Schedule C, hey, look at our website, irs.gov. There's plenty of info. irs.gov small biz is where we have this stuff. But these are expenses that are already deductible that don't directly relate to the home. Your advertising, your taxes, car and truck expenses, salaries or non-employee compensation, your supplies, your products, your materials that you make things out of, travel expenses. These aren't limited to the business use of home deduction. They're not limited to a percentage. Why? Because these are directly related to the business. Couldn't run your business if you didn't have customers. Couldn't get customers if I don't have advertising. I have to put out a sign. I have to make flyers. I have to get an internet marketing service, whatever you pay for. This is already deductible. So don't think it's business use of the home. These are already deductible. Yes. That's an easier way to do it. There are two ways to do it. This is part of the Schedule C class, but it's real quick. You could decide either to do mileage, which is 70 cents a mile. Most people, unless you have a very expensive vehicle, 70 cents a mile is going to work fine to cover insurance, gas, upkeep. Maybe you're still paying on the vehicle, that kind of thing. Another way to do it, though, is you could do it by percentage where you compare the miles. So what that means is you take the actual costs, tires, insurance, the car payment, fuel, et cetera, and then you'll do a comparison. 10,000 miles for business, 10,000 miles for personal. You take 50% of the actual expenses. What you're looking for is explained in the instructions in Schedule C. And if you pull up the form Schedule C, on the back side of it, it's got like a worksheet where it figures that out. And actually, mileage is part of it, but you could take actual expenses or the 70-cent mile. But either way, you want to keep a record. If you're using it for personal and for business, keep a record of how many miles you did for each. That's an easy way to figure out. I used it 70% for business and only 30% for personal. But then you still get to decide, do I just want to take the 70 cents a mile and not add up all the gas receipts? Or do I want to add up all the receipts and do it together? It's up to you. Mileage is a lot simpler, but it may not be giving you credit for everything. Let's say you've got a big diesel vehicle and you're putting gobs of miles on it and it's constantly getting repaired. You know, especially if it's vehicles that are more used for business than personal. So, yeah.
That a few years ago then, or is that no longer applicable? I was thinking that was also included if you're doing mileage, no?
It is. Oh, tabs even. Sure. Absolutely. And again, it's percentage. Did you use the vehicle 50% for business, 70% per business? So 70% of the tabs, if you use it 70% per business, is deductible.
Not if.
Yeah. So, no. 70 cents per mile or these other expenses. And how do you split up the other expenses? By mileage. You're always, if you're splitting a vehicle between business and personal use, always keep the mileage, because that's how you figure out how much of every one of those expenses is attributable to business. Yep. So direct expenses though, and again, this is IRS, how we use the terms, but I want you to know that this counts. Direct expenses are deductible in full unless you hit that deduction limit. And what are the deduction limits? Let's suppose you made 10 grand in 1 year, gross profit. And you spent 10 grand to build the shed. Well, it's going to be limited by the amount that you earned. And we'll talk about how you can carry over expenses into next year if you need to. But let's say you only made 5 grand and you spent 10 grand on the home office. Well, you're only able to deduct 5 grand because you only earned 5 grand. It's limited by by different characteristics. And the most obvious is if you paid more to renovate your home office than you earned, well, you're limited by how much you actually earned. You can't deduct more. But think about painting and repairs and all these things that you might use for the home office that you don't use for yourself. Like maybe you have a separate internet connection. Why? Because you want that to be just business. And I've got my home internet separate, but this is all for the business. If you have these things installed in that office, that counts as a direct expense and you get to deduct all of it. Indirect expenses are based on the percentage of the home. So these are things like you got a roof put on, general repair. You put on a roof, but that roof and the business expenses attributable to it are 10% because it's 10% of the house. Can't deduct the whole thing. Similarly, insurance and utilities. You're not using 100% of your electricity for your business. It's based on the square footage of the room. That might not be exactly how much electricity you're using, but you're basing it on the percentage. So these are indirect. They're your insurance, they're your mortgage payment, your rent payment, your utilities in general. You get to deduct a percentage based on square footage. But also know that some of the expenses are going to be unrelated because they're considered not used for business. And these are the ones that I have seen people get audited on: lawn care or landscaping in general. Oh, this is the best looking house in the neighborhood because I spend a ton of money paying a landscaper. Well, none of that is part of the direct or indirect expenses of the business. They're going to be called unrelated expenses if they're things that are outside of what is normally part of the home repair. Okay. One of the expenses I saw like this was a guy was trying to deduct his pets as security for the business. I'm not kidding. All of the costs, the food, the whatever. And I'm sorry, that's your household pet is what they were told. You can't deduct those kinds of things. It's an unrelated expenses. Similarly, if you had some renovations to a part of your house that didn't include the business, it's not going to count. Yeah.
For intention for, we're going to start, that's our home regularly for the business. So we do have an intention of doing lawn care because we'll be inviting people in the home to conduct business. We run a local newspaper. So would that be considered part of the expense? And we wouldn't do the lawn care if it wasn't for the fact that we're going to be conducting business there.
Unfortunately, the problem is that what you're talking about deducting is not even in the home. It's outside the home. So even, and so this is why it's an indirect expense. So unfortunately, no. And part of that is really just based on how they figure this credit. It's the home. And so the property itself, they could be radically different. Imagine if you had 5 acres or you just have a standard lot. The expenses are radically different and might not be related. How it might be related though, imagine if you were a cidery, like one of these cideries that has a farm area. They might have a better business rationale for why they need to have stuff outside the home. That's going to be industry specific, and know that you have to have what, again, comes back to that word reasonable, right? I have an outdoor area where I built these areas. That's where you might be better. Build a pergola, right? Because that gets square footage. Okay. Build a shed. It doesn't even have to have walls. It's just, if it's got a roof, there's a lot of different, and in this area, you see a number of folks that are doing those kinds of things. If it's got a square footage that's delineated, you'll get to, but if it's just expanses of lawn, you're going to have a hard time directly saying that it was needed by the business. The other thing, I forget the exact verbiage, but it's something like, paper in your house isn't the best tended in the neighborhood. Maybe that's directly related. sometimes you might need to be more creative about how that works as well. One of the most creative ones I saw for landscaping was, and I saw this guy had a construction business. He had people do repairs on his house and basically paid their wages, but didn't have to pay profit and paid net cost for all the materials as kind of an apprenticeship program. And he got the benefit of a well-tended yard and landscaping done. He wasn't necessarily deducting those expenses, but he was deducting the payroll because he was training these employees. So he didn't deduct the costs of the house. He didn't deduct the costs of a lot of the other things, but what was he deducting? The payroll. Sometimes we may not fit. Lawn care, that's one that people tried to use in the past that if somebody abused it in the past, that's where these exemptions come from. Yeah. Mhm.
Even though the lawn care area is being.
It's going to come down to the way we have it written is it's only for the area that's used for business. So that one is going to be an indirect expense because it's general repair. Again, though, that's percentage. So then you want to just use the percentage of that cost. So let's say that garage, you use 75% for business, but only 25% for personal. As long as you spell out where your rationale came from, then even that, which normally it'd be an indirect cost, but not all of it applied to business because part of that garage is used for personal. That's a good one. I mean, I think you make a good argument for why it would be direct, where you get to deduct the whole thing because normally the garage wouldn't need that. And so this is part of prepping yourself for an explanation for the IRS is I couldn't meet with clients in a garage that wasn't insulated. And just because I happened to insulate that portion, I think the only way to kind of protect yourself, if you even questioned it, was I used the garage 75% for business, 25% for personal. Therefore, I took 75% of all the costs. But you got a great argument. And honestly, that's a tough one. I don't know because the insulation, like you said, applies to the personal part. So maybe it's 75 to 25 or whatever percentage you happen to break out. It's not as obvious in that case because in this case, it seems like it could either be an indirect or direct. And part of what makes it confusing is, like you said, you've got an expense you wouldn't have done normally, but because it's used for business, well, it has to be hospitable. You have a good argument, but I don't know. A lot of times whenever there's questions like this, internet's your friend, but also I recommend getting with a tax. And whenever you do go into a tax professional, you're paying for them to do a service for you, but it pays you as the business owner to educate yourself and to have your own understanding of taxes so that you can walk in and even just pitch it to them. Hey, I'm considering putting this in as a direct expense because I wasn't going to have insulation if I didn't need to have my garage warm enough for people to sit down and discuss business. What do you think? And your accountant may tell you one thing or another. But always double check these expenses with your accountant. Just because I told you something at a meeting, pretty much everything I'm giving in these meetings is so general and so broad that it can't apply to every single situation. So I'd say put some thinking into it. And like you've already pointed out, you've got a good, reasonable rationale as to why this was done just for the business. So what are these deductible expenses? I just don't want you to forget parts of your expenses because it's real easy to forget some of these expenses. Real estate taxes, especially if your home's paid off. You don't have a mortgage. Well, you're still going to have real estate taxes. So percentage of your real estate taxes. You've got deductible mortgage interest, sometimes mortgage interest premiums. Other times you have casualty losses, like you maybe had a fire, right? And some of these expenses are only deductible if you use your home for business. Insurance, rent, repairs, utilities, and depreciation as well. So even if you have a home that's paid off, depreciation could be part of it. Even if it's just a separate structure like a shed. So I would recommend working with an accountant on this because I've looked at the math and it needs detail oriented. It's not like it's calculus or anything. It's just math, but it's carrying over records. Depreciation is designed to give yourself credit for how the wear and tear on that shed or that room is going to be affected by you doing work in there, doing business. So you are going to be able to deduct depreciation. That these are some of the examples of the expenses you can deduct. What are the limits? So the first limit, you can't deduct more than you brought in. That's what that means on the top. Gross income from business equals or exceeds your business expenses. You spent $10,000, you made $11,000, you can deduct $10,000, okay? If your gross income is less than your total business expenses, it's going to be limited by the gross income. And especially if you're new in business or you're just starting up a business, it's easily understandable that you're going to spend more in the first couple of years than when you have enough customers, when you have your system figured out. You know, you're probably going to spend more because you weren't as efficient at doing business early on. So expenses limited to your gross income. You get to take out your ordinary and necessary expenses, right? These are your advertising. These are your products, ordinary and necessary. Those are your standard business. That's all deductible on Schedule C. Then business part of expenses. So your expenses are limited to business use of the home minus these expenses. Then the good news is any expenses done in those years where, in a sense, you just didn't make a profit and you're deducting everything was expenses. Well, if you've still got a few $1,000s more than you spent to keep the business, to get it up and running, to make the signage, some of these things are designed to last many years. They're not just made for one business year. So you can carry it forward. I also recommend getting an accountant to help you with carrying forward a percentage of your expenses from year to year. Just because it requires record keeping that goes over multiple years. But especially if you're starting up, you can report the expenses up to the limit, and then the expenses you didn't get to take this year, you can take next year. Why? Because you're using the same equipment, you're using the same business office, you're using the same computer that you used to start the business. Here's a look at your 8829. And the 8829, just to remind you again, that's the form that you document your business use of the home. So it starts out, line 1 says, what's the area regularly used for business? What's the total area of the home? And remember, give yourself credit. If it's a separate structure, make sure you get the numbers right. Then just divide the two, and that's your percentage. It does have in bold listed the special rules for daycare facilities. So daycare, this middle section is just for the daycare. Leave those blank if you're not a daycare. But essentially your line 7 is your business percentage. It's the percentage of those costs that you expect for business. So it's meant to be a pretty straightforward documentation of your square footage. And then part 2 is going to be able to figure out your allowable deductions. So essentially what this is trying to do is to make a difference between the stuff you're deducting on the Schedule C and the stuff you're deducting as business use of the home. It wants to just make sure you're not taking that deduction twice. Don't take it on the Schedule C and take a percentage of it on business use of the home. Okay? That's really all this is designed to do. It's designed to make sure that you are not double dipping, so to speak. And then what it does is then helps you calculate the limit of the allowable expenses that you're going to be used on your home. Also, since you have multiple businesses, be aware there is a page about the specialized rules designed to basically figure out how much is from the income of one business versus another. Think about the limits, right? What if one business is just much less profitable? Well, then you don't want to be limited by that limit. You want to allow them all. So similarly, if you have more than one business you're operating out of the same space, know that there are specific instructions. They're on the instructions for 8829, and you'll also want to use the Schedule C instructions. And so here's your Schedule C, right? And the part that they omitted is the stuff that has your list of expenses, where it's got a category for supplies, maintenance, automobile expenses. It's got lines for all your advertising. It's got all of those categories listed. But here, this is the business use of the home. And so what it does, it calculates then what's your total expenses before business use of the home. So it takes your gross income, minuses your regular operating expenses, gives you that number. This is where you add in the business use of the home. And you can either put it in as the simplified method, where it just says total square footage of the home, total square footage of the business. Easy enough. Otherwise, you're going to use the worksheet 8829 to put it here. So this line 30 is either 8829, where you're calculating all the expenses, doing it by a percentage, or you put the simplified method, which is $5 a square foot, and claim that dollar amount. And that also then, that's its, in a sense, its own separate deduction. That's where you get your net profit, so that you're only paying taxes on the net profit after all these expenses. Sometimes it might be a loss. And if you have a loss, look at the instructions, but that loss essentially is what you're going to be carrying over to the next year. So again, get with your tax preparer and talk about that and say, hey, I spent more this year than I earned. Can I carry it over? And then you can talk about how that works.
David, it sounds like it's too general, if you simplify it. Like, for example, your internet costs. It sounds like, you're better off doing all that on your Schedule C. And then doing like your simplified for your use of your office.
It depends. Again, it comes down to, is this the internet that's just for the business? Well, if that's the case, yes, don't even do it as business use of the home. The only time business use of the home has to have special calculations or rules and percentages is when you're taking a cost that is in part personal and in part business. So if you have internet for the house, well, some of it's personal, some of it's business. How do we split it up? Well, we don't have a convenient way to check how often you're going on the internet for business. Similarly with electric and water and gas and all these things. And depending on your business, it may make more sense to, that's the business internet and here's my home internet. Especially if you had to have an especially robust internet system for your business that nobody would need for the home internet. But if you are primarily online and you're doing things that are going to need a high internet bandwidth, well, then it makes sense to separate it out. So this is good thinking on that. In other words, sometimes it makes more sense to just say, no, this is so much of an expense that I'm going to have this as my regular Schedule C expense. I'm not going to include the internet under business use of the home, and I'm just going to charge it all to the business because I'm not using any of it for personal. I can't think of any others offhand, but there's got to be others as well. Expenses that you wouldn't have if it wasn't for business. I think that's not a bad way. If you're using any service for the home for personal use, then I would use it as business use of the home and split it by a square footage percentage. Just because that's the whole reason this is pulled out of the Schedule C as its own expense, because you're using some of it for personal and some of it for business. So you have to then figure out a percentage.
Because you need to deduct.
Yes, that's the reason that it goes under business use of the home, is because this is an expense you're splitting between your personal and your business. Any expense that's clearly the business, right? Like advertising. Well, that's all attributable to the business. But electric, water, gas, sewer, if you're renting your home, then a percentage of the rent, and it's based on square footage. Yep. And you had a hand.
David, on the preceding page, there a question down at the bottom, 32 A and B. All investment is at risk and some investment is not at risk. What is the meaning of that exactly?
You want to read the instructions on that, and basically you're going to find that there are a couple of different specialty terms that the IRS uses. Think about it this way. If there are guarantees.
Oh,
It could be for a product you're selling, or it could even be guarantees that maybe you're a franchise and you have guarantees with from your franchise. Investment at risk is most businesses, especially sole proprietors. Why? You took your hard-earned money that you earned somewhere else, you already paid taxes on it, and you invested it in something. But some investment is not at risk, is more rare. But what they're saying is that some of these costs may not be deductible because you, in a sense, you weren't really running a business. It might be a personal venture, or it might be guaranteed by other partners. This applies more for, and this is why the word investment is a good part of it. But you're going to find that they're also going to ask, is your investment at risk? Look at the instructions on that, but basically just that means is if you lost everything for the business, is it a personal loss? That means the investment's at risk. But if you lost everything and then those business loans get written off in a bankruptcy, then some of it's not at risk. And some of it comes down to liability. Like if you're an LLC, some things are at risk personally, some things are not at risk personally. Like your personal home, your business could be liable for lots of losses, but if you're an LLC, it's limited to the assets of the business. So there's a lot of cases here, and I'm not an accountant, I'll tell you that. So I'd say just check out the instructions, but if I were to guess, it's more common that all is at risk. So what you can't do is take a double deduction for some of the deductions you are deducting elsewhere. This is less common now. They changed the tax code about 2018, 2016, I forget exactly. But the standard deduction is now much higher. And then what people call itemized deductions, which is the Schedule A, is is more rare. And part of the reason for that is they just radically increased the amount of the standard deduction. So what is deducted on a Schedule A? If you've never itemized, you might not know, but it's things like real estate taxes, mortgage interest payments, mortgage insurance premiums, sales taxes. We don't pay an income tax in the state of Washington. Sales tax is deductible. Other types of taxes like excise taxes, like let's say you bought a car in Oregon because you didn't want to pay sales tax, but you brought it here and you pay the state of Washington then an excise tax to license when you license it. Okay. So there are a lot of types of, oh, and medical. That's a big one on the itemized deductions. If you had a really difficult year and you spent more than 10% of your income on medical deductions, you get to deduct that on the Schedule A. That's a pretty rough year. If you're spending more than 10% of your income on medical deductions, you're having a rough year. So that's where you get to deduct that. But what they're talking about here is going back in your memory to this 8829 form, you're saying 25% of my mortgage interest, I'm going to deduct. 25% of my real estate taxes, I'm going to deduct because I'm using 25% of my home for business. Well, you could put that on business use of the home on Schedule C, but you're going to need to back out part of it for Schedule A. Is that making sense? So let's say you had $10,000 total for your mortgage interest, and you're deducting 25% of that. Let's say 25% of your business or your home is business. You get to deduct 25% of that. But if you're also using Schedule A, you're only going to be deducting the part that you didn't already deduct on the Schedule C. That's what they mean by don't take a double deduction. So don't take the form you got from your bank that says mortgage interest deduction and use it to calculate a deduction for business use of the home and use that same exact number on the Schedule A because you already got credit for part of it for the home. Business use of the home as part of the business. But in some cases, if you're spending a lot, you might be able to do both. But keep in mind, the amounts reported on the Schedule C, business use of the home, and the amount reported on the Schedule A is the total. If you're splitting this up and you're doing it this way, there's a publication 587, and this whole course I'm talking about today, that's where the IRS communicates what the law is. Publication 587. So if you need the resource on it, go to irs.gov. You don't have to print it. It's all available online, and it'll let you know all the rules. But that's pretty much what this is saying. And it's the same sort of thing with any of these Schedule C expenses versus business use of the home expenses. It's one of the reasons why you're thinking the right way. This is not benefiting me to deduct it as business use of the home anymore because I'm not getting as much credit as I would as if it was 100% deductible as a business expense. And that's where you're talking about using your garage for business and you're also using it for personal. At a certain point, do the math and think maybe it's better that that's all business now. Why? Then all that insulation is deductible, right? So every case can be a little different, but sometimes it makes more sense to just say, this is no longer part of business use of the home. I'm taking that on Schedule C. Why? Because I only use that for business. One thing to be aware of, if you are regularly using business use of the home, you're deducting costs of using your home. And so in a sense, you're getting reimbursed for paying the mortgage, paying the rent for your business. So that means if you do sell your home, good thing is this doesn't apply to apartment dwellers. But if you go to sell your home, you're going to have to be aware of how much that credit was year to year. So again, record keeping is really important to make sure that you don't get caught Essentially, it's paying back the government a percentage of what the profit on your home is. Why? Because you got reimbursed for the mortgage payments, for the mortgage interest, for the real estate taxes while you were running that business. So you have to pay tax on part of the gain that's equal to what you claimed or what you could have claimed for depreciation. So if you're renting, you don't get to sell it. And essentially what it's saying is the government subsidized part of your mortgage so that when you sell it, you're reaping the benefit of that without cutting the government in on the part of the gain that mattered. So they call this, the term is what's called recapture. The government's recapturing part of its incentive that they were giving you along the line. Record keeping is important, but again, this is just the percentage that applies. So if you were looking at 25% of business use of the home, look at the dollar amounts and pay tax on the gain that is equal to what you claimed. The good news is with inflation and with home prices around here, it's probably going to be a lot less than what the inflation on the price of the home will be. But keep this in mind, work with your accountant on this, and just keep your records so that knowing that if you take this deduction up front, it'll calculate it. Now, interestingly enough on this, if you claim the simplified version, you don't have to pay that back. Again, that's limited at $1,500 based on having a 300 square foot office. You don't have to pay that back. But if you're doing the percentage method, the IRS wants to recapture it's part of that. So one of the reasons why we mentioned this is in previous years, business use of the home has been one of those areas where people abused it. And so because of that, this is a complicated one, but just because other people have abused it doesn't mean that you can't do it right and get the benefit of it. So I don't want you to be scared of it as much as just to know what an illegal tax scheme looks like. Non-deductible personal living expenses can't be transformed into business deductions. Like I talked about, the guard dog that's actually their Chihuahua pet, or various other expenses that, like, do you have to have a swimming pool for your construction business? Maybe not. Is your swimming pool really used for business? And you could come up with all kinds of complicated arguments as to why. Like you point out, you wanted lawn care. Well, unfortunately, that's been abused in the past. So because of that, that's one carved out saying that one doesn't make sense. So don't try to be so, don't try too hard. If it's obvious that it's a business expense, you'll have a rationale. But if you're trying to transform upgrades to your own home that aren't directly related to your business, that's where people have gotten into trouble on this before. Especially upgrades to your home, renovations, repairs, those aren't normally deductible. The only time renovations, repairs, and upgrades are deductible is under business use of the home. So that's why the IRS wants to be very careful that you're not just rebuilding your entire home, taking advantage of a deduction for it, when in fact it wasn't directly needed by a business. Do all the other daycares out there need that? Do all the other plumbers need that? So just be aware. IRS.gov has examples of what we call the dirty dozen, taking deductions for expenses that don't always quite make sense. So this is a review, and this kind of hopefully will flesh out in your mind whether it's time for you to do this year as simplified or whether this year you're going to do the standard method. You deduct the home office use, that's part of your residence, if it's exclusively and regularly used for business. That's my office. The kids don't get to mess around in there. The dog doesn't get to play in there. My guests don't use that as the guest bedroom. The allowable square footage under simplified option is up to 300 square feet, and it's $5 a square foot. The regular method, the standard method, you're going to calculate this percentage of the square footage of the house. And remember your separate structure, add that into the square footage of the house, then do the math. And you'll use actual expenses, and you'll keep the records. You keep the records of your mortgage receipt. You keep the records of your electrical expenses, your sewer, water, gas, oil, whatever you have. Under the simplified option, you can deduct your home-related stuff that's personal on the Schedule A. And there's no depreciation deduction and no recapture when you sell the home. Because you're only getting $1,500 a year. But maybe that's enough. Maybe you just have a small office at home and everything else is done outside the home. But if you're using the regular method, that's where you're splitting up. Hey, my personal deductions go on the Schedule A. My business deductions go on the Schedule C. And the percentage of these is kind of split up based on who paid how much. If you're in farming, Schedule C and Schedule F, somewhat different, but if you're in farming, Schedule F is the one you're going to be using, okay? Simplified deduction, the $1,500 a year, you don't get to depreciate use of the home. So that's something that doesn't even come up. You don't have to keep a record of it, and that's why there's no depreciation recapture when you sell. However, if you're using depreciation for a portion of the home for business, then that's when you sell the home. You're going to need to do a calculation on how much you pay back. And it's roughly the percentage of the profit that made a difference. Yeah.
Say you're in business for 5 years, use of the home, they're at 10 years and sell it. Do you just calculate then those 5 years?
Yep.
Does it go back to infinity?
No. It's just when you, and in fact, this is where it comes back to, think of it this way. How much credit did the government give you during those 5 years? They weren't giving you anything in the other years. So only it's limited by the amount of the credit, and especially more important when you use depreciation as a measure than just a percentage. Think about some of the deductions we talked about for business use of the home that aren't recaptured anyway. Insurance costs. That's not part of the mortgage. Electric, all the utilities, all that stuff, that's not recaptured. What's recaptured is mortgage interest payments, mortgage deduction, that percentage, and depreciation. In other words, what's directly related to the home. And they don't go back to infinity, no. You get to document that I got a 25% deduction for each of these 5 years. The dollar amounts were these, and you calculate that percentage of the gain based on that. That's why an accountant may be good to help get together with on this, because when you sell your home normally, there's a huge amount that's not taxable. Right now, for a single filer, it's $250,000 in profit. And for a joint filer, it's $500,000 in profit. So you still won't even pay on a gain up to that amount unless you took depreciation. And so, but again, we're not talking about paying the most of your profit on the sale of the home. We're talking about recapturing what tax credit did you have. Maybe it's a few $1,000s, maybe it's smaller even, you know.
Said can't switch between regular and simplified in a year, but you can next year.
Next year, right.
Go back to the simplified when.
Oh, you could do that, sure. Yeah, because it might not make sense as much anymore, especially if your business changes, right? I was using my home exclusively in the first year, so I had lots of expenses, and then I graduated next year, and now I have a storefront. and most of my business now is being done in the store. Okay, then you'll change to simplified. Why? Because you're only using the small amount of the office. But in your first couple of years, maybe you used the entire basement as a production facility. But yeah, you can't switch midstream in a year, but you can switch next year. Similarly, just to remind you, your deduction can't exceed your gross income. Pretty straightforward. And if it does, there are ways you can carry it over. If you're using the standard method, you can carry over expenses. And part of the reason is you're documenting this. You have all the documentation. I got all these records. Here, you don't have to have any documentation. It's already limited at $1,500 a year. And so you don't get to carry it over next year. Okay, there's nothing to carry over, right? Loss carryover from the regular method from a prior year can't be claimed. So for example, let's say you started your business and you made $1,000 in the first year, but you had a $1,500, you get to take the simplified method because you had a 300 square foot office. So that's $1,500 you could deduct, but you only made 1,000. Well, that means there's 500 left over. Well, guess what? If you're using that simplified method, you don't even get to carry that 500 over to the next year. If you're using the regular method, the loss carryover can be claimed if in that next year it doesn't exceed your gross income. So give yourself credit. This is part of startup costs as well. It's a whole separate section at irs.gov, but I would put it in if you're a new business, look up startup costs. You can deduct startup costs of a business that involve even things like research. Do I even want to get into this business? You can deduct various costs involved. Now they have to be real costs. You can't just prorate your time and say, well, I'm worth $50 an hour and I spent 8 hours researching my future business. That's not quite how it works. But if you spent $1,000 signing up for a conference and spent a week learning about how your business works, that is deductible. How do you do it? Well, I'd go to our website and look that up. But this is kind of part of what happens. Carryover is part of carrying over expenses when you invested it in a year that you just didn't make a lot of money, but it's gonna cause profit down the road. You want to be able to take credit for that investment in your business. So remember your requirements to qualify for the deduction. Exclusive, regular, primary place of business. Determine the percentage that works for you. Figure out what types of expenses are deductible. Look at the limits of what you're going to deduct and only deduct that. Know that where you want to deduct them is going to be on your tax return. Keep in mind if you use depreciation and what the effect will be on recapture of that amount. Record keeping. Keep the records that you need. Electronic and digital record keeping makes things a lot easier for most folks. I know one guy who told me at one of these meetings that he has a scanner and he just scans every single document that he has, every expense that he has, and it goes right into a file on his computer. And then he could just drop that into a box. He says, that way I don't have to file all the paperwork, but I know I've got it because that scanner put it right into a file. So figure out a system that works for you. But once your system works, it allows you then have all these things. And then tax avoidance schemes. It's not that I expect any of you are going to do this, but be aware, once you're a business owner, you're going to get all kinds of advertisements from people. Hey, I could provide you this service. Hey, I could do your payroll. Hey, I could be your accountant. Hey, I could do whatever. Some of them are legit. Plenty of them are. Plenty of them are scams. And we want you to know that if somebody comes to you and says, oh, you paid how much in taxes? Well, I can show you how to make 100% of your home deductible as business use of the home. Be careful. You know enough about it to know that the IRS has rules. And if they can show you a way to save taxes Maybe they are a good accountant, but if it's a too good to be true story, be aware it could be a tax avoidance scam. One of the ones that I'm seeing lately is for farms. If you're in farming, you can't deduct depreciation of your farmland. However, what you can deduct if you're in a certain area is mineral rights. So one of the things that's out as a scam right now is they'll tell a farmer to create a document offering to sell all the mineral rights for your property to someone. And if there's no minerals really to be purchased, no one's going to buy it. But you can show that, wow, I had this on the market and it's been depreciating and these mineral, and you're deducting mineral right deductions. It was a scam that was reported. That promoter is now paying fines for that because that's not legit for a farmer. They simply just can't deduct depreciation of the land. But this was a scheme that somebody cooked up to say, hey, I got an idea. So be aware of this. Some people victimize business owners. You get your choice, simplified method, standard method. If you got questions, let me know. My email address should be in your packet of notes. My phone number's there. Let me know what's going on. Not only do I want to like pass on information, but I'm the ears of the IRS as well. And so if you find something confusing, I pass it on. In fact, what you brought up to me about the possibility of a direct cost being something, I wouldn't have renovated that space, but it's partially used personally. Maybe it is too complicated. I pass on your feelings as a taxpayer to other people. Now, whether or not it makes any long-term change, I don't always see it, but we want to hear what taxpayers are running into. What did you find? Was it too difficult to do the standard method and the simplified method doesn't give you credit? So you just don't like that. Fine, tell me. Okay. And I get to put it together and pass it on, but let me know. And if you don't want to let me know, let Sammy know and Sammy will tell me. Again, also Washington is now on the free file, and even business owners can qualify for free file, and business owners can get earned income tax credit. If you're not making enough money, the government can help as well. So I definitely want to encourage you to take advantage of free file if you can.